Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. We have in the front row right now, in the shock of these markets, the perfect guest. Stephen Wieting is with Citigroup, and just to say the least, he is steeped in the linkage of our economics to our markets. Steve, I can't think of a better person to start with. Is our economics linked to our stock market right now?
Well, it is, but it is out of sync in some ways from the way it has been in the past. We had been, just looking back at the last year and a half, in a period of poor corporate profits with a few magnificent exceptions. If you take a look at global EPS ex Mag 7, it was about negative 7% last year. And we now see it recovering while the labor market, which was torrential in terms of its rebound from the pandemic, is slowing down. So slowing employment and rising corporate profits. That's this moment.
Anna Wong, publishing moments ago on LinkedIn, follows up with her zeitgeist changing birth-death analysis. This is inside baseball, folks. Only Wieting reads this stuff. I don't. But Anna says it's here, and the job revisions will show a more tepid American labor market. Do you agree?
Well, let's just be careful to see the actual data.
Well, she says that. She says that.
Yeah, the levels versus the growth rates. And, when you're dealing with, 150 million people, what does that necessarily mean? But I think if you take a look at the labor market, and this is all discussed in our Citi Global Wealth Midyear Outlook report we're releasing today, what you're seeing is a real slowdown in gross hiring. And despite all the, the reports on the layoffs, they're not up that much in the aggregate, but a real slowdown in hiring. And you can take a look at the JOLTS report. We've had 4 million fewer unfilled job openings from, 12 million, 8 million rounded, right? So, this path is coming down. Then there's something else. Now, this is really zooming in on the near term, and people get very crazed about this. But we had over 260,000 jobs created in the first quarter of the year. Guess what happens at mid-year, right? We have a less seasonal economy, right? We're just thinking about agricultural cycles. Maybe that's the one that people can think about. We don't need to hire and fire everyone because of the time of the year the way we used to. If you take a look at economic surprises, the Citi Economic Surprise Index, you will see that it's stronger in the winter and weaker in the spring and summer. And suddenly everyone is saying this, economy was torrentially strong, is now in a bust again. And that is not really happening either. But it wouldn't surprise me if job gains are about half the first quarter pace.
Interesting. So, Steve, I'm looking at the Wealth Outlook 2024, the mid-year edition for you guys. Renewed growth, new challenges, building resistant portfolios. Is a resilient portfolio? Can I back away from the Mag 7? Can I try to do some homework here and try to find some value outside of the Magnificent Seven? I
think we just have to take a look. When you're dealing with $3 trillion companies, maybe you can take an individual view. Okay. I would just say that for every chip maker, there's a customer, and if all of those customers are all spending like mad all at once, we might think about their moats in the future and whether or not they're going to be competing in the same space. And, the good news, and again, the renewed growth part is on profits. I think 10 out of 11 sectors will have EPS gains this year. I think a much larger swath of the world will have EPS gains. And it's not that they're all going to be valued the same. That'll never happen. But the rise in profits is the positive catalyst for more of the world equity market.
All right. Well, how about in fixed income here? I mean, Lisa Mateo is sitting in here at a 2-year treasury, darn near 5%, no gray hairs. She sleeps fine. What's wrong with buying a 2-year treasury and just sitting there?
Well, the world doesn't end in 2 years, though. That's part of the issue. So the treasury market very efficiently is embedding a lot of easing, and the inverted yield curve makes it difficult. But, when the Fed says that its long-term normal rate is 2.6%, let's say that they're exaggerating. It isn't going to be that low. What can you do with a 4-year duration? Where will you want to be in 4 years in terms of the interest rate that you're earning? And we think, again, there are big pieces of the bond market that, without a lot of duration risk, can earn you 6%.
What are we going to see in issuance? What are we going to see? I mean, this is a nuts time. Even people that have nailed this, they own NVIDIA to the moon. Agree, there's a resonance, an anxiety to it, a frenzy almost. As Ed Yardeni says, it's the roaring 20s. What are CFOs going to do? I mean, I look at the bond issuance, and this is not Zvi Bodhi up at BU. There's something going on here. Why aren't we seeing normal financing, Steve Wieting?
Well, look, I think I guess that, the thing that's most surprising, if we look back now, that in 10 of the last 15 years, we're close to a zero policy rate. And we had this wonderful period in 2021 where Americans could get 2.5% mortgages again, and and say, put that on the wall. In the U.S., I think we've had just tremendous amount of refinancing and locking in, of really good levels here that make the equity market better. And have limited our need for refinancing. Right. I think, again, it'll pick up. There's some increase in interest costs. And even the U.S. Treasury is better off because of the Fed's tightening. And I know that we've had a couple $100 billion increase in the level of our interest costs. That will still go up in a bit of time. But they've knocked it out. They've stopped this from being an early 80s kind of environment.
Okay. Steve Wieting, thank you so much. Mike Wilson. He joins us now, somewhat cautious on this great bull market. Mike, how does a cautious bull play the madness of this technology rally?
Yeah, I think that's a good way to phrase it, Tom. I mean, it is a bull market in a lot of different areas of the market, and many parts of the market are in a bear market. And so that creates a really good opportunity at the stock level and at the index level. Now, of course, everybody knows about the concentration in the index. Everyone knows about the incredible outperformance of the high quality growth stocks relative to, say, low quality small caps, and that's what we've been doing. Is we've been really trying to create the relative value trades within the market. The one that's been the most consistent. There's been several over the last 18 months, and by the way, I should have set the stage. It's a late cycle economy. In a late cycle economy, full employment, the Fed is fairly tight. They're maybe about to start cutting. Typically, large cap quality is the place to be, and that is essentially the S&P 500. Mm-hmm. So that all makes sense. And I think there's a sort of this appetite to want to veer away from that, to go down the quality curve. Everybody saying, well, we can't keep buying the same stocks. And the reality is that's the way it usually is at the end of a cycle, and it can go on for longer than you think.
Mike Wilson, if we get a breakdown in yields, and I've got a 10-year real yield, 1.99%, check, yes, 1.99%. If yields actually break down for whatever Ellen Zentner reason, how does that change equity dynamics?
Well, I mean, look, it depends on why yields are falling, okay? So if yields are falling because the Fed is going to give us some sort of insurance cuts here, which is Ellen's view, and quite frankly, that's the Fed's view too, right? They're not, I mean, they're signaling they're going to cut rates because they can, not because they have to. And in that environment, well, that kind of speaks to more of the same, which is that we continue to see, high quality stocks outperforming. Now, by the way, it doesn't have to be 7 stocks. It can be areas in industrials. It can be some healthcare stocks. It can be consumer stocks. But what usually does well is, as rates come down slowly because growth is slowing but not crashing, is higher multiples. And that's the environment we're in. And that probably persists. Now, things are stretched on a valuation basis, and we've written about that. That's why we're not as bullish as others in terms of where the index can go over the next 6 or 12 months. And so therefore, we're trying to find opportunities away from the stocks that have already run. And I would say the other theme that's worked really well is operational efficiency. So companies that maybe aren't growing as fast in the top line, but are doing a phenomenal job of managing their businesses to, generate cash flow from whatever revenue they are getting.
Hey, Mike, talk to us about, I guess, the industrial economy here. Is this a sector we should be looking at away from the Magnificent Seven? I mean, I've got a government that's talking about a lot of fiscal stimulus here, a lot of investment spending going forward over the next decade or so, and maybe even some rates coming down. Is the industrial sector someplace where people should be looking for some opportunities?
Well, we think so. We've been talking about this for about a year now, and for the reasons you've mentioned. In many ways, I would say the industrial sector has more legs to the stool than the technology sector, right? The technology sector has AI spending, but quite frankly, core IT spending is somewhat in a recession right now because of all the payback from the COVID pull forward. Meanwhile, industrials have, the CHIPS Act program, they have the IRA policy, they have the reshoring, they have the infrastructure upgrades that are going on all over the world, the green infrastructure sort of retrofitting. So there's a lot of sort of irons in the fire that can drive strong revenue growth for capital goods companies. Now, once again, not all industrial companies are created equal, right? Now, they're not all going to benefit equally from this sort of trend. But, the capital goods companies that have exposure to those types of spending should continue to do well.
So one of the other areas, Mike, a lot of folks think about is just, how about this energy space here? We've got WTI crude oil now down below 75. It was, as high as 90 just several weeks ago. What do we do with global energy here if this world is trying to move towards a greener energy space?
It is. I mean, look, I think energy longer term, intermediate term is probably still an attractive asset because we're going to continue to use fossil fuels even with the green transition. However, in the short term, energy prices have been under pressure for two reasons, I think. Number one, we've seen a little bit of a supply boost from OPEC talking about over the intermediate term they may continue to produce more. It looks like Saudi Arabia is trying to take share back, and prices have come down for that reason. But I also think there's a little bit of a sluggish demand picture that doesn't get a lot of attention. And this is one of our concerns about the broader market, which is that we still think there's a decent chance of, not just a soft landing, but also a hard landing and a no landing. And we just don't know the outcome there. And so we are watching the energy space closely as a signal that maybe driving demand as we go into the summer or other forms of demand for energy is not as robust as you might think, given the strength in the overall economy.
Mike Wilson, I got 1 minute left. How do you use cash now as a hedge? Are you fully in the markets with your caution, or is cash a constructive tool?
Well, you always have some cash on the sidelines. You should, as any asset owner or investor should. I mean, obviously, if you're an asset manager, it's a little different. And I do think the barbell of cash and high-quality stocks has been the place to be, and it probably will continue to be the place to be as long as we remain in this sort of late-cycle, soft landing-ish outcome, right? So in other words, cash is probably better than long duration because long duration has risk, and you're getting another % return on front-end cash. Like, there's nothing wrong with that. But being fully invested in high-quality stocks is also part of that strategy.
Mike Wilson, thank you so much. We speak with Monica Defend, head of Amundi Institute, of course, of Europe, on this ECB decision. Monica, just to frame this for Lagarde and the challenge of the press conference, is there disinflation in Europe?
Yes, we think that the trend is there, but the direction won't be linear. So we do expect a little bit of stalling and then volatility. And on the back of this, probably we will have actually the cut today, but we are not expecting a cut to come in July. Just because on this disinflation that is taking longer and is lower than expected, they are not really in a rush to cut further.
Paul, I see on the nominal GDP question, core inflation there, 2-ish. I'm going to say as a conversational point, get out to growth, which is not what you'd expect from the Fed. Next year's growth, 1.4%, down 1/10. So you got a nominal GDP that is different than the nominal GDP of the party you're going to in New Jersey this weekend.
Exactly. So, Monica, is this the ECB telling the markets, global Wall Street, that inflation in Europe is in check? Is that what we're hearing today?
Yes, this is probably what is happening. But if I can go back to your point before, having in mind that the central banks won't target the GDP growth, it's really on the output gap. And this might help us explaining what to expect from the central banks, notably the Fed moving forward, where the output gap is narrowing and is expected to progressively narrow further.
So, Monica, give us a sense of just kind of broadly defined how the EU economy is today. Does the EU economy need these rate cuts, or is it kind of rebounding on its own?
Well, the EU economy has proved to be less resilient than the US. We came out of the post-pandemic in a slower manner, but we think that now, at least for the second half, we are just approaching to potential. So we are coming from south, approaching the potential growth. Obviously, within the Eurozone, there are countries that are really running at different speed. And this is, if you want, complicating the job that the ECB has to do.
So given that backdrop, Monica, when you talk to your institutional investor clients at Amundi, where are they looking for opportunities if they're willing to take some risk in this market?
Well, we really need to have magnifier lenses. So because top down is really difficult to find convincing structural investment opportunities. When it goes to Europe, probably having the ECB set for further cuts and the cycle that is expected to renew some momentum, small cap, might be an interesting opportunity, as well as UK equities, for example, just because of its sector, the equity composition, the sector composition of the equity market. When it goes to the US, probably our clients are a little bit more cautious, right, where there are plenty of opportunities in emerging markets.
Monica, is there a divide at the ECB? Lagarde has done such a good job of straddling the political tension, but on this historic day of a rate cut in the ECB, even around an inflation forecast that lifts, that in itself is absurd. But Monica, how big is the division, say, between Germany and Finland? I mean, just as one example.
When it goes to inflation, for sure there is, just because all prices have been impacted in a different way, the two regions, and going in that granularity is what I meant with having such a hard job when it goes to the ECB decision. But having said that, probably there is this core of countries that, because of the weight that they have also on the markets, that I'm not saying are in the driving seats, but possibly are definitely relevant as a market impact, at least.
Do you agree that there's a little bit of vibrancy here in the Eurozone? They look at a growth lift for 2024. Do you agree?
Yes, I agree. We really think that because of the Olympics, because of tourism, there are there is going to be some seasonal momentum. Obviously, what the Euro area needs is an industrial policy that can set the region into a longer structural higher trend.
Monica, thank you so much. Monica Defend with us with the Amundi Institute. Jon Stoltzfus joins us because he knows you just got to be in the market to win. Jon Stoltzfus, how have you amended your bull market call in the last number of days?
Good morning, Tom, and thanks for having me on the show. Must say, really haven't amended it a hell of a lot. While we have recognized the fact that the utilities are really performing remarkably well, which essentially suggests to us that the market is becoming more confident on a Fed cut, and I think much more realistically now focusing on cuts for probably in November and December of about 25 bips apiece, maybe only 1 to 25 bips, and maybe just to continue with, as other guests have said today on your show, indeed, it's coming, and the Fed has been remarkably successful at a hike cycle. 11 hikes, 7 pauses, or skips, as they call them, without putting us into a recession thus far.
Hey, what do you make, John, of these earnings here we've had? We just had a pretty, I guess, decent earnings period. Is it enough to support this market here if we have a Fed that's going to be kind of staying on the sidelines a little bit?
Paul, I got to say that the earnings we think are really pretty phenomenal. The overall number, shows growth at around 7.7% on the EA page on the Bloomberg terminal, and on back of earnings of around 4%. And that is much better than expected at the beginning of the earnings season for Q1. I recall, I think it was about that people were looking for about 3.9% in the surveys in terms of earnings growth. And when you look at it, it's 8 sectors, positive earnings growth. And within those 8, 6 of them double-digit earnings growth, only one of them a defensive sector, which is the Utes. But you've got communication services, you've got consumer discretionary, you've got information technology and financials with double-digit earnings growth. This is a big deal. And very seldom mentioned. You have to lift up the hood, right?
Exactly.
Bring out the Bloomberg and lift up the hood.
You mentioned utilities. Is this just a play on AI, or is there something I'm missing here on utilities?
Paul, I think it's 2 things. One is most of the utilities, as I recall, in the S&P 500 ute sector are regulated. So they've been experiencing higher costs in terms of fuel and operational costs now. And so likely the regulators granted them increased billing. I mean, for those of us who have Con Ed, do we know it? But the reality is they're earning more because likely the regulators have naturally given them the ability to raise their prices. But the other story there is the longer term story, or the duration story, as we say nowadays, anything tech related. Likely is that Utes are likely to be huge participants in the build out of the new grid in terms of transporting electricity and the whole process of producing it. And that's the longer term story that I think investors who are intermediate to long term are looking for, on top of a dividend, on top of better earnings, et cetera.
Paul, years ago, did we have market timing? Was it as big as it is now?
I don't know. It's tough to do, that's for sure. Market timing.
What Stoltzfus has done, what Gino Martin Adams done, is a miracle. I mean, we're underplaying this, folks. Second leg of a bull market. Yuri and Timmer is arguing 7th inning or 5th inning, but these people had the courage to stay in the market.
Stay in the market. And if I want to stay in the market, John, in the fixed income space, do I just hang out with that 2-year treasury, or do I try to get a little bit smarter, maybe take some credit risk?
It really depends, Paul, on what type of investor you are. If you're really more adept at diversification, you can look for opportunities in credits and municipals. But it certainly, for now, the front end of the curve is a really comfortable place for putting cash into, because you've still got an inverted yield curve related to the short end of the curve. So, but what we would say is we think bonds at this point are not competitive with stocks, because for intermediate long-term investing, we believe that it's stocks where you want to be. Just consider, from the end of October last year, when the rally began, October 27th through yesterday's close, the S&P is up 30.04%. If at that time one had decided to just with the 5% Treasury, which was around where the 10-year was, as I recall at that time, 4.8, 4.9, you'd still be waiting to get that 4.8, 4.9, and the S&P is up 30. Now, at Infotech, 44.93, communication services, 42.35, financials, who would guess it, up 31.1,
right,
and industrials, 27, and the last one that I'll mention is consumer discretionary, up 21%. Now, no guarantee of future results, but certainly to pause and ponder.
Right. Jon Stoltzfus, thank you so much. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.